So welcome again to another video. In this episode, we're going to be talking about market structure shift. In previous video, we talked about swing highs, swing lows, and how to map them out properly without doing shortcuts. So just think that maybe when you map this low, it's going to be a swing low. Maybe no. This is not a swing low. This is not a swing low. Yes, this is a swing low. This is a valid swing low, and this is not a swing low. So in previous video, I talked about this one, and welcome to market structure shift and discussion and trading. This is part of market structure, deep deep confluences or deep understanding of how to read price correctly. Because if you miss these things, you're going to be thinking like you know what you're doing, but definitely you're doing things wrongly, and that always end up in losing money. So I want us to begin by market structure shift. Once you understand this, you don't need anything like break of structure. You don't need like change in character and so on. Change in character, break of structures are very weak compared to market structure shift. And guys, this is my secret. Nobody talks about this thing. Of course, it is ICT concept, this market structure shift, but I think I understood this way better because I don't think ICT teaches this thing directly the way I'm going to be talking about here. Because it took me so long with a lot of backtesting and study for me to be able to understand what exactly this ICT doesn't usually give you people a direct entry towards his concept. He usually hides them, so he might give you he might give you a direction, but he won't give you the exact thing, so you have to go and put in heavy work, back testing, learning. So market structure shift, I can't believe I'm sharing this out, guys. Yeah, I have a lot of goodies in my docket in terms of technical analysis and so on. So this is just part of it, but you know when God gives you something for free, you have to give it out. And I'm not charging anybody for this. So here we go. I talked about swing highs and swing lows in the previous episode. If you haven't checked it out, make sure you do watch it, because if you don't understand what a swing high is or a swing low is, then you're just wasting time. A lot of you people have always mapped something like you'll see somebody saying now this is a market structure shift, right? This one right here, or somebody will say that okay, this is a market structure shift. Like I've seen some crazy stuff online. I've seen some very, very crazy stuff. Okay, if I may ask you people, we took liquidity over here. You guys saw in the previous video, I talked about we had a swing low. Some people had put their stop losses right here. We came back and took that liquidity. This candle closed back in, showing signs of or interest of going even higher. So if we have interest of going higher, the older me or the older version of me would be very impatient. I would already engage in this trade right here. And I know most of you do the same. Because now you think now, since we've swept liquidity here, now it's time to push higher. We have to wait for something called a market structure shift. Yes, some people say break of structure on lower time frames, but I like using the same time frame. It's way, way more powerful, and in terms of win rate, it has the best win rate with very less noise in the charts. Taking very few trades, but they're high quality trades. So you see, for example, somebody here would be going out to lower time frames, and then they enter, then they put their stop loss here maybe, and you see, like they don't have confirmation in this time frame. This time frame has not even given you guys like, yes, now this is a heads up. Now you guys can push. Now you guys can push further or push higher. So how do you know that we are finally going higher? And this is how you do it. In previous episode, I taught you guys how to map out the swing highs. For example, this is a swing high right here. As you can see, all the swing highs that I was marking, let me just mark them again. This is a valid swing high in hourly time frame. This is a valid swing high in hourly time frame. This is a valid swing high in hourly time frame. And we also have another one right here, which is just next to this one. So I'd pretty much, okay, but I have to mark it because if price even ends up using this, then definitely that will mean something. And apart from that, we also had another. These two were invalidated. You see, once that they've been taken out, like this one. You see, this candle took them out. Once they've been taken out, they are no longer valid. That's something also I want you guys to note. Now, once they've been taken out, we now remove our interest from them. Now we work with the one that has taken them out, the newly created one. So take a look at what's happening here. And apart from that, let me just mark them up properly. Do we have any other one more here? No, we don't have. We don't have any swing high here. Perfect. Do you have anything here? Nope, nope. So you have to always look for these things. You have to literally look out for these things. And sometimes I wonder, how do people end up trading so many pairs, yet one pair itself needs a lot of attention, a lot of lookout, a lot of analysis. For example, you see over here, this is Thursday 25th, 2026, and I'm like, I'm just looking for these swing highs and swing lows on hourly time frame. I can't spot them here. And you see, this takes time. If you want to do this properly, like, you're not going to be jumping from one pair to another. No, you have to map them out and see exactly. For example, something happened here. Now, this is what I call market structure shift. Some of you would have said, this order block, we had another block right here, and now you see, because of this order block prices, going on. If that's the case, this was also another block. There's another block here. There's another block here. How comes price ended up, manipulating those flows, right? So it's not only about order block. Order block is just a PDRA. Order block is just like a fair value gap, right? But in terms of market structure, this market structure shift is very, very important. It's so important so that you don't make a mistake of reading price wrongly, because this will determine bias also. If you don't know how to read daily bias, or you don't know how to study session bias and so on, this will answer the question. So this is how we do it. We have our swing high here. Instead of us sweeping the highs, just like we swept the highs, you see, for example, we had some swing highs here. We swept these highs by this candle, and the candle went back and closed back in. Okay, we just had a wick over here. You see what happened right there? Now, the fact that we came back and closed back in, this is a failure. This is a swing failure pattern. Like this is a failure. Like this is not what we're looking for. We're looking for market to displace, or market to give us something that can push above these highs towards the upside. And whatever it is doing, it must create a gap. When it creates a gap, when it does that, guys, this is my secret. That's it. Like, you see what happened over here? So we want to see displacement. And this is exactly how I do this thing. This is exactly how I do it. So there's more to it. For example, there's a way in which I could be able to grade this whole area to know exactly to the tick where it's likely to push out from. But you don't really need that. Once you see this thing over here and there's a gap, all you could do, just look for longs. Don't It's not even a must for price to come down there. You can even buy from there immediately. Put your stop loss right there. And now the question is, what are you targeting? What are you targeting? Some people would say, what, I'm going to be targeting these highs all the way up there, right there. Or maybe some people want to say, I'm going to be targeting all the way up here. Or maybe this inefficiency we have right here. Okay, interesting. That's good. That's round 1 to, is it 1 to 8? Okay. But unfortunately, see what happened next. They were stopped out. Why? And this is the reason. If you zoom out, let me zoom out on daily time frame, because you see this hourly time frame. Hourly time frame is not powerful more than daily time frame. Daily time frame is the boss. So this is the Thursday. Let me remove these strings. This is the Thursday that we were working on. And our first question would be, where is exactly this market likely to be drawn to? We ended up creating a gap. This gap on daily time frame is our primary draw on liquidity, this one right here. So if you're targeting in terms of take profit, take it out here in the first place. Or wait to see how we close on this day, then you will know whether we are likely to push higher or lower. If you take a look at how we closed over here, we ended up closing below that swing low. Take a look, meaning that we respected this gap. We respected it completely. Respecting this gap, and it is a bearish gap. If a bearish gap is respected, this shows that price is interested in something lower. So if it is interested in something lower, what could that be? The swing low here. This is the drawn liquidity. And as you can see, we came back right there. After that, what happens? We start pushing higher. And now, if we're pushing higher, our first point of interest would be this second PDA where you see this gap here. Yeah, we were supposed to see how price works on it. But this would also mean that we have to be very careful. We have to take a look at how is price reacting. Maybe, for example, this short time frames. And you see whatever happened here on, let's see, for example, this Friday. This was Friday. Okay, in real sense, if I'm being honest with you, this Friday we were not supposed to be pushing higher. Price was supposed to be pushing a little bit lower based on this period array that we have here. But you see, it ended up pushing higher, and it was a bank holiday, meaning that geopolitical factors took over. They took over the issue with Iran, Israel, and US. The Middle East issues. took over, and that's why sometimes you see the things which are not supposed to be even happening. Because see, right now, US is kind of embracing gold, and we're not sure if they're going to be increasing the interest rates, because if they do, that simply means that that's going to be bad news for gold. If they increase the interest rates, then gold is going to be dumping. But if they keep it at standard, then yeah, that's going to be quite 50-50 for gold. But if they do increase it, then it's going to be bad news for gold. So take a look here. We displace above the swing high, displacement about above that high. You guys take a closer look. Displacement right there. You could just by immediately put your stop loss right here. When you're targeting, don't target all the way up there. Target the liquidity I was showing you guys on high time frame. This was that was the bullish, daily gap. It was around somewhere there. Once it is filled, once price has completely tapped it, then walk away. For more advanced traders, for people who really have done this for longest time, you could end up putting your stop loss below, just below this low. You see this low here, this one, yeah, and that will increase your risk reward, of course. But also, you see how risky it is. Not unless you've done this for quite some time, you understand how it works. Now, guys, this is what I call market structure shift. Displacement, not just displacement. Displacements creating a gap. So you'd wait for for the smart ones. They would maybe grade this dealing range, and for example, I would done something like this. I would have done something like this. Let me just show you guys quickly. I would have done something here. Yep. Let's see. Yeah, I would be definitely waiting for buys from this PD race here. Once price come to that zero point 0.5 of that range, this is the zero point 0.5. This is the equilibrium. So once it is in equilibrium, meaning that the upper side of it is premium, the lower side of it is discount. So where you want to buy from? You want to buy it from the discount side. So once it touches the equilibrium and it starts moving towards the discount area, you look for PDRS. For example, we have a gap here. You would use that. You could use that. Apart from that, this is an order block. You could use that. So we have an inefficiency, and we also have an order block. Definitely, these two is enough for you to get an entry. So a smart one would have maybe even gotten a very good entry from from this gap right here. And there's stop loss. Take a look. Take a look. The same level. I told you stop loss is gonna be below this low, right there. Take a look at the risk reward ratio. How much has it increased? This is now 1 to 8. You see that? And definitely we're very somewhere up there, around 1 to 9. You see that? So this is how you optimize entries. But if you're a beginner, don't even think about it. Don't even think about mapping out what you guys have seen me doing here. For example, that dealing range, but just look for this swing highs. If you're anticipating for market to reverse, if you're anticipating, because you see for this reversal event to happen on daily time frame, let me show you on daily time frame. Everything here happening has confluence or has alignment with the daily time frame. We had a daily swing low here, right here. We've been pulling down all this. We've been coming down. This candle here end up taking liquidity right there, but it becomes more of a liquidity grab. This is not a sweep. We ended up, closing below it. You see it? It goes back up, takes some swing high into that gap, drops again. Then when we're here, we were anticipating for this liquidity to be taken. So once this liquidity has been taken, once we see something like a market structure shift now on lower time frames like this one, now on hourly time frame, you see, and you see it was now Thursday. If let me go back on daily time frame and show you how the manipulation, accumulation, distribution also kind of work. So there's a lot of conferences in this thing. It's not just one thing. So it will take time. It will take a couple of years, a couple of time. You can't rush this thing because you'll make mistakes. But the most important thing is that when you're learning from the right person, definitely it's gonna skyrocket. So this is Wednesday. Wednesday we end up delivering as usual. Delivery on Wednesday. Monday we gives us accumulation, Tuesday manipulation, then Wednesday, delivery. Then Thursday we're supposed to having reversal, then Friday reversal or continuation, right? Take a look at what happens. We end up, delivering on Wednesday. This was the delivery point. We delivered right there. So the issue was that how did we deliver? We ended up, displacing aggressively below it. I did not like that, to be honest with you. But the fact that we on lower time frames like hourly time frame, we ended up having now Thursday we're looking for reversals. If Wednesday dumped, we're looking for Fridays to be Thursday to push higher for longs. Now take a look at the hourly time frame. Take a look at the hourly time frames and see what happens. On early time frames, we were looking for possible buys on this Thursday. So Thursday, we're anticipating for possible buys, right? This is what's happening here. We were anticipating a reversal on classic Thursday reversals. So when you are anticipating reversal, what exactly are you looking for? We're looking for signatures that can align or side with that reversal. So in this scenario, we ended up having that market structure shift. Price comes back in, we just become patient. And if you don't want to engage these charts, we don't want to be watching, what you do is very simple: put your buy limit there and walk away. Now, if you put your buy limit here and walk away, this doesn't, mean that now you have to be reckless or careless, because once it delivers here, take a look at what happens. It reverses. So what I usually do is this. Once I put a buy limit here, I also put an alert like this. I'd come here and put alert. Let me show you guys what I usually do. Right there, you see there. So for example, if my point of interest or drawn liquidity, for example, in this scenario was this gap, I want you guys to take a look at this. Take a look. Our drawn liquidity here was this one, this gap to be filled, this daily gap. You see it right there. Yeah. So that's where I'd put my alert on. So meaning that if price ends up delivering to this alert without giving me entry, I come back manually and close, delete that limit. Because once this has been delivered, what do you expect? It is always about PDA rate to PDA rate. It's about liquidity or swing point or inefficiency to the next one. It's one to the other. So this is exactly what happened here. That's what I'm telling you. You have to be aware. Take a look at how price, filled that inefficiency immediately after, filling that inefficiency. Take a look at how the candles were behaving. See, it started rejecting that area. Then the next day comes in, Monday. What happens? Boom, we start dropping. And when you are dropping also, this market was also still giving you guys opportunities to be able to engage into this sell. So assuming that you bought right there, it is delivered, and now this new week. So you're coming from, let's say, in New York, maybe you're like trading New York, but if you're trading London, then definitely you'd be looking for these structures like these bearish inefficiencies. For example, you'd have just seen, okay, we have a gap right there. Wait for time and price. I'm definitely talking about macro. Sell it. We ended up creating another gap here. Now this is what I like. You see that similar? We displaced body below it and created a gap. Beautiful. This is what I like. What do? You sell it. Stop loss just above that candle. It will be just something like this short like this. Sell it right there. Stop loss above this high of this candle, like that. What are we targeting? We are targeting these lows because these are now our drawn liquidity. Some people put their stop loss right here and they're greedy. They want to take it all the way here. With these are our targets. We are going after them. See what happens. This is how market makers do their thing. That's another 1 to 7 hour, guys. Take a look at that. This is the week that this is the current week we just closed on. This is how you would have engaged in this market. See, like that. But it takes a lot of patience and a lot of just being disciplined and so on. Right. Now, this entry here happened on Friday during Asian session. So of course, maybe some people are not in them. That's what I'm saying. If you understand what you're doing, if you know what you're doing, put limit and walk away. You'd have gotten entry right there and delivered the same day. The next week comes in, you start seeing price action. You enter right there during New York session. I believe this was New York Open. I'm using UTC plus 3, of course. So, and as you can see, we delivered. It's the same thing that happened over here. The same thing, price coming back to that order block, to this inefficiency after this market structure. And you see, we pushed higher. The same thing right here, coming back where? So this is how I usually map out my trades and market structure, and it is a all lot of things. It is not just one thing whereby you have to learn market structure shift. Yet it I agree, as a beginner you just learn one thing and stick to it, but you need to understand the confluences of what's happening in the markets. So as promised, I've delivered, and I'll see what I can maybe to teach you guys in the next episode.